Hi, everybody. Welcome to the 7 and 7 show with Zack, Ellison. Today we have with us Mike Ryan, who's the CEO of Bullet Point Network. And Mike is also the former head of global equity products at Goldman Sachs and the head of equities and absolute return at Harvard Management Company. So Mike, thanks for joining.
Yeah, great to be with you, Zack. Thank you.
So before we dive in, tell us a little bit about your background.
Sure. So I grew up in Staten Island, New York, and then I went to Yale University, which was a great opportunity for me. Went there to play basketball and learn, and ended up coming out with my wife, my first job, and a set of relationships and skills that I've been benefiting from for 3 decades since. Went right to Goldman Sachs and spent about 2 decades at Goldman. Started out as an analyst, really consider myself an analyst today. That's what I love to do. That's what I do best. Ended up sticking around Goldman, was a partner at the time of the IPO and for about 8 years afterward. And as you mentioned, I eventually co-headed the global equity business for the firm. I went and started my own family office after leaving Wall Street. I still have that family office today, but maybe 5 years or so into doing that, Harvard University asked me to manage some money for the school's endowment. Ended up managing about $6 billion of direct investments, plus another $12 billion that we allocated to other funds as an LP and co-investor. Left Harvard to start Bullet Point Network, which is a software platform that we built and patented and licensed to Harvard, and an analyst team. We work for and with growth equity funds, venture capital funds, buyout funds mostly, building the strategic scenario model for the companies that they're thinking about investing in. And sometimes we continue to work with the companies themselves. And we can talk later about the strategic scenario model and the framework. But that's kind of my background and my career in a nutshell. Got 5 kids and married and active in lots of things in New York, but I don't know if we have time to talk about all that today.
Mike, it's great having you on because you've got such a diverse background and have had success everywhere you've been. So in terms of what you're thinking about right now, there's a lot of interesting things going on with Bullet Point Network, but is there anything you're thinking about that you feel like the market's missing?
Well, I don't think the market's missing things. One of the things that's sort of fascinating to watch is how risks and opportunities that are hiding in plain sight get misunderstood or don't get factored in thoroughly enough or properly enough. This is a very dramatic time. I think we've seen now a massive change, and I think the most important element of it is we've lived most of our lives. Most of us have spent most of our professional lives in a world with virtually no inflation and with low and very stable, perhaps manipulated and compressed interest rates and risk premia. And we're now having to address the possibility that we'll have real inflation for a decade or longer. And that's not unusual. If you think about 5,000 years of human history, that's very common. But for the last 40 years, that hasn't been common. And as people are coming to grips with that, it's going to really change the way businesses operate and how you make money running a company. And it's going to change the way portfolios have to be managed and how you can manage risk and make money in an environment where you have non-zero interest rates, non-zero and positive persistent inflation, and just a level of risk and volatility that's more normal in a 100-year or 1,000-year history, but seems abnormal because it wasn't there for essentially 4 decades prior to maybe the last year.
So in terms of portfolio construction, what are the changes that you think PMs will need to make for this new environment?
Well, diversification is a common word and everyone knows it's super important. And I think we get reminded of it whenever we have shocks and volatility. So I think everyone is going to revisit and redouble their thought process around really how exposed they might be to some risks that double up or triple up in the same direction, and how diversified their portfolio truly is. The other thing that I think is going to be front and center, and I and Graham and Dodd and Warren Buffett would argue should never have been anything but front and center, but profitability. Growth is great, and I think growth is something. I'm a growth investor, and I spend most of my time working with growth companies, but there was a window where the markets weren't requiring discipline about profits or a clear path to profitability. And, that's, I think, a pretty long-term change. I wouldn't say a permanent change, because I'm sure, like skinny ties, ignoring profits will come back into fashion at some point. But we had a window where it was absent. And now I think everyone has got focus and religion on the fact that you better have profits, or at least a clear path to profits. And, if you don't understand that about your managers and how they're thinking about that question, or about the underlying investments themselves, I think you need to rethink it, because essentially that's the big change, and it's going to last for the next 5 to 10 years, not 5 to 10 minutes.
Yeah, we've been seeing that a lot in the early stage ecosystem, where the shift has gone from looking for companies that are very high growth to companies that can get to break even and a steady run rate pretty quickly. You do a lot in growth equity. What are you seeing there in terms of themes and trends that are emerging?
Well, you're right. I really am attracted to growth businesses. I never want to bet against growth and innovation and technology and the ability to do things better tomorrow as a society than we did yesterday. And I think that's still a trend that's worth absolutely betting with and looking for opportunities in. But just as we were talking a minute ago, it's really critical now that the operators of those businesses and the investors in them appreciate that capital is scarce. It's just not ever flowing. And there was a window where interest rates were zero, where funding was available for Series A and Series B and Series C rounds at ever increasing amounts without as much discipline on the return on capital and the profitability path that the companies were on. And that's just, I think, been a healthy change back to normal. It was really the abnormal window that stands out when that wasn't so much in focus. But look, innovation, technology, disruption, the ability to do things better than we were doing yesterday or last year is, generally speaking, the best way to invest, because those companies have competitive advantage, they have moat, and they have sustainability. But you got to make sure that those statements are true, that they actually do have a sustainable competitive advantage. Otherwise, they're not going to be able to just fund themselves forever because the investors are going to require a little bit of results on that.
What are some core investment principles that you live by, and do those shift in different roles, whether you're an allocator at Harvard, for instance, or a PM or an asset owner potentially? Do you think that there's differences in principles that people should be utilizing, or are they all kind of the same? And which ones do you really live by?
Sure. Well, it's a fascinating question, particularly with the juxtaposition between investing in funds or investing in companies. One core principle that applies equally to both and is very, very important to me is people. And I only really want to invest with and work with people who are trustworthy and competent. And that sounds like a very easy standard. It actually rolled right off my lips, just simple bar, trustworthy and competent. But when you work with folks that are both of those things, I think the results can be really exceptional. And unfortunately, most people fall down to some degree on one or other of those standards. In terms of investment principles and translating that, I actually think there's a bit more commonality than most people do. Most great CEOs and business leaders themselves are good capital allocators. They're good decision makers. They think about allocating time and resources and money to opportunities that will deliver returns. And so good leaders of businesses are good capital allocators and good decision makers. And good investment fund managers are good allocators of capital and good decision makers. And so I really like people that have the right balance on their team and in their own individual composition and brain, the right balance between being creative and being able to see and imagine opportunities and spot new trends, but also being systematic and disciplined and having a rigorous, repeatable, scalable process to go through. Because I think if you combine those two things where you're open to and good at spotting opportunities, and then you're rigorous and systematic about how you go in a disciplined way through the analysis, I think you get really good results if you have that combination. But trustworthy and competent people who have a systematic, rigorous, repeatable process, it works for fund managers and it works for CEOs and boards of companies.
So on the flip side, what are the risks that keep you up at night? And how do you think about risk management as part of the portfolio management, portfolio construction process?
Yeah, good question. I mean, again, first principle of risk management is diversification and not putting all your eggs in one basket. Another good rule to live by is we think considering scenarios. We're very big believers in thinking about possibilities and probabilities, and the seemingly unlikely events do happen. And if you haven't considered them in advance, you're more likely to be victim of problems in them. And on the other end of the spectrum, the seemingly unlikely upsides also happen. And in a funny way, the odds of the outliers is one of the most important things to consider, along with your thorough, rigorous analysis of whatever you consider the most likely or base case. And so when you marry together, diversification, not putting all your eggs in one basket, with considering scenarios and the odds of the outliers, I think you have a pretty good recipe for risk management of all kinds. And in some places, I've run derivatives businesses and I've done formal asset allocation work, which tends both to be very quantitative. I've also looked at early stage companies and investing behind founders, where really all that's going on is you're betting on the founder, the product, and the TAM. In both cases, it's equally important to consider the odds of the outliers and consider scenarios for what kind of success might unfold and what that might mean for the company and for your portfolio and for your investment. And so I really like the ability to think in terms of scenarios and try to quantify stories in terms of odds.
So putting together the principles that you live by and how you think about risk, are there investment strategies that you like for the next part of the cycle?
There are. I think there's going to be, there tends to be two great and timeless ways to make money. One is to correctly identify a trend that's forceful and obvious and invest behind it, but be careful not to overpay. And the second is to be a contrarian of sorts, to be early and visionary, or to be contrarian and lean against the direction of sentiment. But then you have to be right. Being a contrarian who's wrong is very dangerous, and following an obvious trend but wildly overpaying for it is very dangerous. And so I really look for those situations. And one of the things that's pretty interesting to me right now is there's a couple of kinds of businesses that people love for good reason: SaaS businesses, recurring subscription businesses. And they love them because recurring high margin revenue is a holy grail of investing. Those businesses were dramatically appreciated, I would say, with a euphoria over the period of 2017, 2018, 2019, very accelerated and aggressively into 2021 post-COVID. And while they continued to be enormously attractive businesses to own, they did get somewhat overvalued in many places. And now you've had a correction in values because interest rates and risk premium have been appreciated, and they've collapsed the multiples that you have to pay for those companies. And so there's actually some very interesting opportunities around, but you have to be careful because you have to know the customer acquisition cost and the churn and the ability to truly retain those high margin revenues. And then you have to, be careful about the valuation. But that's an area where it's always been exciting to me. It got very expensive, and some things that were great businesses were not great investments because they were pricing in 50 to 100% growth for 7 to 10 years, and they were pricing in 30 or 40% profit margins. And the list of companies in history who have had 75 to 100% growth over 10 years and have 30 to 40% bottom line profit margins is very small. And the number of companies that were priced for that was very large. And so you had to really understand what you were betting with and against. And so thinking hard about what's priced into the investment as the last stage of the decision-making process, but a critical stage, is something that I'm very attracted to. And I think now we're starting to see in public markets and in private markets a lot of opportunities to buy great businesses at really great prices that you can make money on, instead of just owning a great business and not making a great return.
So within the startup ecosystem, we've been seeing a difficulty in raising capital. Certainly on the equity side, it's been very difficult for companies coming out of the boom years. Now they're seeing much smaller deal sizes, much higher cost of capital due to lower valuations. It's taking deals a lot longer to get done. And one of the themes that we've seen is the emergence of debt as an alternative or complement to equity financing for startups. And of course, this has gotten very, very interesting recently because we've had a number of regional bank failures like Silicon Valley Bank, First Republic, Signature Bank, probably more by the time people watch this podcast, quite frankly. And so lenders in general are pulling back. I think personally, we're headed into a severe and prolonged credit crunch potentially. And so this is really making it very, very difficult for startups to raise capital. And a lot are looking towards debt. And we've talked about this offline and some of the opportunities in both equity and debt. But what are your thoughts around venture debt as an opportunity going forward?
Sure. Well, again, I think venture debt and just a full capital stack, like a complement of financing tools and solutions, is going to be part of the landscape for the next 5, 10, 15 years. I think a lot of folks are looking at it wrongly as a window, a short burst of opportunity because the banks that failed, that you mentioned, did fail. And what I think is that there's going to be, just like there was post the so-called great financial crisis, where private credit became mainstream, and the alternative investment platforms, the non-bank lenders in that space have had just a tremendous tailwind and tremendous growth. And they're very, very important now in the ecosystem for middle market companies and even large size companies that are doing private credit. The same is going to be true, I believe, for venture debt for the earlier stage and early growth stage companies. I also think a variety of convertible structures and hybrid structures are going to become very commonplace because, as you alluded to, the need for capital or the demand for capital really hasn't changed. These companies still need capital to invest in R&D, to invest in sales and marketing, and to grow their business. And the availability or the supply of capital has changed pretty dramatically. There's far fewer IPOs. Just going to the end of the spectrum, there's been a 90% reduction in IPOs. And we've seen this before over the last 3 decades. IPOs will come back, probably not fast and probably not with the force of volume that was happening at the height, but less public market exit availability, be it SPAC and IPO, is going to be a real constraint. Private capital, there's still a lot of money in private equity hands and in venture capital funds, but the volume of deals, the terms and availability of capital is markedly lower than it was at the height. And I think that's partly because of the endpoint. It's harder to take a company public. It's harder to get an exit. And it kind of sounds like almost a silly thing, but every investor is looking to see what the next chapter will be. So the seed investor wants to look ahead to the Series A. The Series A investor wants to look ahead to the Series B and C. The Series C investor wants to look ahead to either the strategic merger exit or the IPO. And as those things become a little bit less frequent and a little bit less certain, animal spirits kick in and people are less willing to advance money. And so you have far less equity available. Most of the rounds that are being done and publicized are in one way or another inside-led or inside-influenced rounds. They're really, the current cap table is taking the lead, and they're doing it for good and valid reasons. They know the company best. They're also doing it in some cases to sort of protect their own prior investment. And so we have to sort of recognize for what it is, the sort of inside round validation compared to new money coming in and investing, which is a more credentializing moment. But less available equity, less public market exits means you need more debt, you need more hybrid or convertible securities. And, I think becoming smart about how to build a capital structure, who to work with, who your lending partners and capital providers will be, going to become a core competency in the growth sector and to some extent in the early venture stage startup phase.
Great points. I mean, we're seeing that a lot in the sense that there's just a lot more interest in learning about how to optimize the cap structure of early stage companies. And a lot of founders aren't necessarily well versed in finance. They're not CFOs, they're company builders, and they're oftentimes visionaries and leaders in many respects, but they oftentimes don't have expertise in managing their own capital structure. And I think that's going to be a very interesting part of the market going forward, because companies that can optimize their capital structure are going to actually have a competitive advantage over their peers. And ultimately, as a founder, the goal is to maximize the value of the company you've built and maximize your ownership in it. And personally, I think historically, we've seen a lot of value go to the funders relative to the founders. And oftentimes companies that did IPO and were successful, I've saw the majority of the gains go to VCs and other funders, and the founders actually had a very small percentage of equity when the company was monetized. And that's one of the things that I see quite a bit, and one of the reasons why founders are really interested in learning more about venture debt when it finally gets on their radar, because they realize, wow, I can actually keep more of the company that I've built. So why would I not want to do that?
Yeah, I agree with that. I mean, one of the things that we look at Bullet Point Network all the time is we build cash flow scenarios. When you boil it down, when we quantify a story, we're building logical, probabilistic cases for the cash flow of the company under different paths, different levels of success that they might experience. And then we're doing valuation, where we think about discounted cash flow analysis, multiples analysis, and we layer in a capital structure to that now, and we can look at capital structure differences. And scenario planning is even more important when you have debt, because if you fall below certain thresholds with debt in your capital structure, you face real consequences that could stop you from being able to continue as a company in the way that you wish to. So you have to really understand that. On the other hand, to your point, availability of capital and those who have capital access to fund their growth is going to become a truly differentiating competitive weapon. You're going to have the haves and the have-nots. You're going to have companies that have raised enough capital and have diversified sources and have trusted good partners for both debt and hybrid and Series A or B equity. And then you're going to have those who don't have access to capital, don't have the right capital partners or funding sources, and those companies are going to be in trouble. Capital access and availability is going to be a competitive weapon for growth stage companies. And in the past 5 years prior to mid to late 2021, it wasn't that much of a competitive weapon, frankly, because everyone was getting funded. And now it's much more discerning and much more disciplined out there among equity providers and debt providers. And I think being able to navigate that's going to be a competitive weapon. And so companies that think through it properly, do the correct scenario planning, and then have the right partners, right capital providing, solution providing partners on the debt, convertible, and equity side are going to be winners.
I 100% agree. Most companies fail early stage, certainly, because they run out of cash. So clearly the ability to access capital and be well capitalized is the number one factor that's going to keep companies in business and allow them to achieve their full potential. So I appreciate your thoughts on that, because a lot of people don't really understand the role that debt plays, but it's definitely improving in terms of the market's understanding. So we're almost out of time. So I wanted to ask you two last questions.
Sure.
One is in terms of the key investment themes over the next part of the cycle. In broad strokes, what are the key themes that you're thinking about that you think other investors should be thinking about?
Well, I think it's easy to bet against growth at a moment like this, and I don't think it's a good idea. I think you still want to be hyper-focused on companies that have a competitive differentiation and can build a moat around their product and service so that they can grow, because growth does solve a lot of problems. And if your business is growing, you have a lot of opportunity for success. But the obvious, corollary to that is you need to do so profitably, and you need to have the ability where your costs are managed and you're developing a path to profitability. And, unit economics have always mattered a tremendous amount, and really understanding the unit economics of a business translating that into how that produces cash flow is really the key for us. That's what we do with our strategic scenario models, and that's what Bullet Point Network's really built around doing well. In terms of sectors and areas, I think it's obvious that software and technology is going to continue to grow as an important influence. AI is, again, having a moment that is very powerful and obvious as a trend. That's something that I think fits into category one. It's a powerful, obvious trend, but you have to be careful not to overpay for it, because there will be winners and losers, and the valuations being ascribed are very lofty. But AI and software are clear areas of focus. I think digital health and healthcare continues to be pretty interesting as well. There's a lot to be done there. And, lastly, I think a variety of businesses are being transformed by technology. And so it doesn't fit a neat SaaS box always. Sometimes there's hardware being sold. Sometimes there's hardware and then a subscription to follow. But the combination of a business that is using innovative products and then benefiting from some kind of recurring high margin subscription business, those combinations are really interesting. And frankly, they fall between the cracks because it's not a pure SaaS investment, and some people are allergic to anything that's got a hardware component to it. And so there's a number of interesting business opportunities and investment opportunities in there.
I couldn't agree more. I think it's all about innovation and figuring out how to access it safely and capture the upside while limiting the downside. And so there's a lot of ways to do that, but ultimately, it depends on the allocator's preferences, I guess, in many respects. But I think we'll see a lot more money flowing towards innovation than we ever have in the past, and that trend is here to stay. In my view, innovation is what drives value creation, and
absolutely,
that's just the way it is. And so with that, the last question of the day is not related to investing. Just for folks listening, Mike's son is one of the best hoops players in the country in college basketball, and recently transferred to North Carolina to be a Tar Heel in his final season. And Mike, I wanted to ask you, who's got a better jump shot, and do you think that the Tar Heels are going to win the title this year?
Yeah, well, Cormac certainly has a better jump shot, and he's put more work into it, and it's a lot better than my jump shot. But I still like to get a few up. But his shooting is definitely a lot smoother. And yeah, he believes, and I'm betting with him, that North Carolina is going to win the national championship next year. They've got a great team. I think his role is something he's really excited about there. And we're Go Tar Heels now. And so he had a great 4 years at Notre Dame. He's graduating from Notre Dame with an MBA as well as an undergraduate degree, and 1,000 points scored, and won some games in the NCAA tournament, and has nothing but love for Notre Dame. But Go Tar Heels. Let's win the national next year.
Easy. I'm rooting for him, and I really appreciate you coming on today. This has been very educational for me, and I'm sure many people listening. And everybody that wants to learn more about Mike Ryan and your company should find you where? On LinkedIn, on the internet? What's the best way to contact you?
Yeah, two good ways to find me. I am on LinkedIn, Mike Ryan, Bullet Point Network, and our domain name is bulletpoint.network, spelled out just like the name of the company, bulletpoint.network. And we build strategic scenario models for venture capital, growth equity, private equity funds, and sometimes their portfolio companies. And so be happy to talk to you about that. And also on LinkedIn, you can just find me and connect, because knowing interesting people who are doing interesting things and are trustworthy and competent in their own spheres has basically been a great recipe for going through my career.
Mike, thanks again for coming on. It's been great having you. And thanks everybody for listening to the 7 and 7 show.